Hi friends, my name is Nilesh Phadke, your learning partner in finance and accounts. In this video, we will learn mainly about the preparation of the profit and loss account and balance sheet and the associated journal entries. Whenever businessman starts any business, he makes sales, incur expense, and at the end have some profits from the business. This is basically recorded in profit and loss account of the statement. At the same time, he takes bank loan for the business, make investment in FDs or other assets, also buy some computer and equipment, plant and machinery for the business. All these transactions are recorded in the books of accounts in the form of journal entries. So let's understand how to file journal entries and prepare profit and loss account and balance sheet with an example. So here we go. Sold goods to Neha on credit of rupees 30,000 at 18% GST. Now in profit and loss account, sales will be recorded as 30,000, due to which total income is 30,000 and profit is 30,000. Assuming this is the first year of operation, so opening profit is 0, so retained earning is 30,000. Now this retained earning appears on the balance sheet liability side, and on balance sheet asset side, receivable from Neha in the form of Neha debtor is created to the extent of 35,400, that is 30,000 plus 30,000 into 18% GST. So out of this 35,400, 30,000 is retained earning arising from sales, and balance 2,700 plus 2,700 is basically output CGST and output HGST. Output GST appears on liability side of balance sheet as it is payable to the government. So company has recovered from the customer and now it is payable to the extent of 2,700 plus 2,700 to government. So on balance sheet liability side, output CGST 2,700 and output HGST 2,700. Now let us pass journal entry. Now Neha debtor appears on the balance sheet asset side to the extent of 35,400. So Neha debtor will be debited 35,400 based on the rule of AID, that is AID, that is assets increases debit 35,400. At the same time, retained earning is increasing. So rule is LIC, that is liability increases credit to the extent of 30,000. However, whenever retained earning is recorded in any journal entry, you do not directly write the word retained earning, rather you write a transaction which is contributing to this retained earning, that is sales in this case. That is due to sales, profit is increasing and retained earning is increasing, on the basis of which we are applying a rule of LIC, that is liability increases credit. Output CGST appears on the balance sheet liability side, which is increasing. So rule is LIC, that is liability increases credit 2,700. And output HGST is LIC, that is liability increases credit 2,700. So being sales to Neha on credit with GST of 18%. Thus we have passed necessary journal entry related to the transaction. Sold goods to Alok for cash rupees 13,000 at 12% GST less 10% cash discount. Now there is a sales of rupees 13,000, so total income is 13,000. Also, we have allowed a 10% discount to customer, which is expense to us. So discount allowed 10% of 13,000 is 1,300 will be recorded in expense. So total income is 13,000, total expense is 1,300. So profit is 11,700. So retained earning is also 11,700. These retained earning appears on balance sheet liability side as 11,700. However, we have received cash to the extent of 13,000 plus GST, that is 13,000 plus 12%, which is payable to government, and at the same time we have given 10% discount, so minus 13,000 into 10%. So thus company will receive only 13,260. that is 13,000 plus 13,000 into 12% minus 13,000 into 10%. Now this 13,000 into 12% amount is payable to government in the form of output CGST and output HGST. So 13,000 into 6% is 780 in both the places. So total liability is 13,260 and total asset is 13,260, and thus our balance sheet tallies. Now output GST appears on the liability side of balance sheet as it is payable to the government. Now cash account will be debited based on rule of 8, that is assets increases debit 13,260. Retained earning is increasing to the extent, not increasing, retained earning is decreasing to the extent of discount allowed. You can see here, due to this expense of 1,300, retained earning is reducing. So rule is LRD, that is liability reduces debit 1,300. However, whenever retained earning is affected in any transaction, while passing journal entry, you do not directly write the word retained earning, but you write a transaction which is affecting this retained earning, that is discount allowed in this case. At the same time, retained earning, that is profit, that is accumulated profit, is increasing due to sales. You can check here, due to sales of this 13,000, this retained earning has increased. So increasing retained earning will be credited by rupees 13,000 based on the rule of LIC, that is liability increases credit. Output CGST also credited based on the rule of LIC 780, and output GST is also credited by 780. So being cash sales to allow with GST of 12% and discount allowed of at the rate of 10%. Thus we have passed necessary journal entry. Thus, to conclude, what we can say is that as a first step, you have to identify whether the item appears in profit and loss account or balance sheet. Once you identified this, based on the rule of AID, ARC, LIC, LRD, you can pass any type of journal entry. So first rule is AID, that is assets increases debit. Second rule is ARC, that is assets reduces credit. Third rule is LIC, that is liability increases credit, and fourth rule is LRD, that is liability reduces debit.